Hi, everyone. Yeah, I think everybody is starting to exploring the bar that is open. So I hope we'll be like quick, but also like insightful. My name is Dima. I'm a CTO at MixBytes, and we're doing security audits. We're working with teams like Lido, Aave, Curve, Fluid. And like, I'm really excited about this panel because I know a lot about like technical side of the blockchain and infrastructure, but in terms of regulation and like institutional stuff, I'm not that like, experienced. So it would be nice for me to explore it today. And let's start with a wave of introduction.
Sure. Hey everyone, Rene Reinsberg. I'm one of the founders of Celo. Celo started off as a layer 1 mainnet, launched in 2020. We earlier this year transitioned to become a layer 2 payments focused. We're about to hit $1 billion transactions on chain. A lot of them peer-to-peer payments or commerce kind of stablecoin payments. So yeah, we've been sort of swimming in that pond for a long time, and it's fun to see more entrants to the game as of recent.
Hey, I'm Charles from S&P. S&P Global is a leading index provider, leading credit rating agency, leading commodity price provider. We launched a DeFi and digital asset team more or less 3.5 years ago. So I'm co-leading that team with my colleague Chuck Mons. Since we launched the team, we raided Sky recently. We tokenized S&P 500 with Centrifuge. We created risk assessment for Stablecoin, and we're looking at many other risk assessment.
Hey everyone, Kenneth from SE Ventures. So I look at 4 key ventures within SE Ventures. It's Zodiac Markets, Zodiac Custody, Libera, which is our tokenization platform, and Swayet, which is a permission chain very big in Europe. Also author of a book on DeFi called Decentralizing Finance. So actually came from the DeFi landscape, but now in CeFi. And of course, Standard Chartered is doing a lot in stablecoins. Happy to share more later.
Hey everyone, Kevin Chan, co-founder of Grove Labs. We are part of the Sky ecosystem, and we're effectively reimagining the ALM system that backs the 4th largest stablecoin in existence today, USDS, previously called DAI. This ALM system is effectively, 1.4 billion in RWAs, tokenized RWA assets on chain today, and scaling out to 2.5 billion shortly. So excited for this chat.
Okay, nice. So Kevin, let's start with you. And like, when you choosing the blockchain infrastructure for deploying RWAs, what are the most crucial parameters that you like think of and choosing between of?
When we talk about I think we talk a lot about the modular approach that our industry takes, and when choosing the right blockchain infrastructure, it's really mainly about having all the right pieces in place in order to launch your stablecoin successfully. I just had the experience deploying on a new chain where basically, a lot of counterparties needed to come together in order to offer the experience that we think users want. We needed TRM labs from sort of like a, chain analysis perspective. We needed stable pairs like native USDC to be deployed and other stablecoins to be existing on the chain in order for proper on-off ramping to occur. We also needed the proper tokenized asset infrastructure to have the collateral available to back the stablecoin that we're launching. So, it really is having all those pieces together at one place is, I think, a critical step for enabling a thriving stablecoin ecosystem on chain.
And Kenneth, if we're like talking about stablecoin deployment for like institutionals and stuff like this, what is like usually a deal breaker for you?
Yeah, well, the deal breaker, it's really down to the businesses. To be completely transparent, we are agnostic, right? In fact, Zodiac Markets has onboarded USDC and USDT on all the chains, on the popular chains. Clearly, before a chain is accepted onto Standard Chartered's frameworks, there's a big onboarding process, right? So basically, it's vendor due diligence. It's a very comprehensive checklist of 50 questions they have to go through. How decentralized is your blockchain? What's the validator set? Founder's background, so forth. So it's a very comprehensive checklist that they go through. So clearly, red flags are excessive centralization or backgrounds that don't check out. But actually, as a business, we are very happy to work with most of the most popular stablecoins like USDC. Yeah, we actually have a very good partnership with Circle. With many of their new L1s like ARC, we're a design partner with them. But in terms of deal breakers, yeah, I mean, it's not so much a deal breakers as in the kind of priorities that we have in the bandwidth to work with the most popular stablecoins. So actually, we really start with the most popular ones.
Liquidity is the most important part.
Liquidity, acceptance on the exchange, the licensing. I mean, we are much better suited at working with Circle than Tether. Although, of course, Tether's USAT is super exciting for us, with the Genius Act upcoming. But yeah, from a licensing perspective, right? If you look at Singapore, XSGD is also an option for us. Like we've done some partnerships with XSGD. So clearly, the licensing is super important, right? We need the stablecoin issuer to be able to attest that they, in fact, have the funds, that the regulator is auditing them. Again, I came from DeFi landscape, right? But, and seeing all of the algo stables and the CDP stables today. But yeah, of course, Standard Chartered really only works with the major Paxos, Circle, and so forth.
Actually, I think it can be an interesting question. What's your take on the CDP stablecoins right now?
Actually, well, from a Standard Chartered perspective, if it say Etherna gets to a point where Etherna is working with BlackRock, right? I think that's super interesting for me. I always view Etherna as an algo stable, right? But BlackRock comes in and does a partnership with them, using their collateral. Biddle is backing some of Etherna's reserves. So from a personal perspective, I love to see the CDP sort of more mechanisms, stable mechanisms. If it survives the test of time, that's great, right? But again, from a licensing perspective, that is, TradFi cannot participate in that, right? Until such time that the Genius Act or the MAS controls over stablecoins change. So that doesn't look to change anytime soon. Yeah, but from a personal perspective, of course, innovation is great, right?
Yeah, I agree. I really like the stabilization mechanism, but if we're talking about institutional adoption, it's a different product actually. Sometimes they don't even call it like a stable coin. It's like some kind of a savings product. So, yeah. And Charles, if we're talking about regulatory compliance, what's your take on it? Is it important for blockchain infrastructure to be in some way compliant, or it's something that you can build on any virtual machine that exists currently?
Yeah. So, well, compliance and regulation, one of the issues we had specifically in the US was that you didn't have any, right? You had regulation by enforcement, and there was no clear rule being set up. But it's changing, as you mentioned, the Genius Act for the stablecoin. So it's not specifically for blockchain, just for stablecoin, but then the Clarity Act and more legislation will be looked at and regulation. It is very important if you care about getting the institution in. You need to have, it's not just regulation, it's also standards. So you mentioned you work with risk assessment and even for something that everybody uses, like a smart contract audit. There's not even a standard definition of what a smart contract audit is. Sometimes you look at them, it's just a description of the code. There's all type of standards that are missing. But the good news is that it's coming. We clearly have in the US an administration that is transforming the field. I just come back from Japan. I go every year just before this event. Last year, the interest in the field was way lower than this year. And this year, they're very interested in stablecoin. And why everybody is interested in stablecoin? Well, because the US now is pushing on stablecoin. So as the US keep pushing the new limit of our field and defining what is important for a blockchain, etc. It will advance. Now, I have use cases that I saw in the past of limitation due to regulation. I can give you one. We had a client and mix between us and a client that wanted to do something on the blockchain, but the problem was that the data was from a specific country. I won't say the country, let's say it's Spain, but it's not Spain. And there are a lot of regulations that are made for database, where it says, well, the data cannot leave the database from the country. So then when you want to do that, for instance, on Ethereum, you could not do it because they would want you to control the validator and make sure they are only, let's say, in Spain. So that's the kind of use case that could not really be done at the time, but well, with the different layer 1 and the new layer 2, etc., that's the kind of stuff that can be done. And also, I guess, the regulation will probably adapt.
What do you think about, like, who will win? Not win, like, but who will push more? Like, the regulation will push the technology, or technology will push in the regulation in the right direction?
Well, I think it's just opinion on my own, but regulation are usually not proactive, and when they are, it can be bad. They're more reactive. And an example is, well, Mika was reactive, right? They saw that something was happened, they did regulation. It's very restrictive. And now the US is doing more, they will adapt it. So I think it's all about adapting to the technology, but also the use case. And when you think regulator and you come from crypto, and I've been in crypto for a long time too, you typically have maybe a bad idea, like the bad guys that were stopping us, right? But when you speak with a regulator in many countries, they're actually wanting to now, at least in the US, but also in many other countries, like here, the MAS, the Japanese FSA and others, they want to understand and they want to create something that can be useful for the country, but also safe for the people. And they are between this need to adapt to the innovation while also this need to be safe. So I think they react, but not always in a bad way.
I think so. Our task is to fill that gap, to help them to build something that is secure but also efficient for people in their country. Okay, and Rene, from the infrastructure side, is it hard to always be on top of to adapt to all this regulation? How much time do you spend usually on it, and in comparison with some unique features?
Yeah, I was thinking about sort of hearing the fellow panelists kind of comment. I think in most cases it's less regulation that's driving things, but just kind of the ever-changing needs or kind of interest, right? So I think, privacy is a great example. It's sort of, top of mind for everyone who's building in the space for a long time, but it really does only feel like now there's actually some traction on it in terms of people really asking for it, wanting to use it, right? So I don't know how many of you were here earlier today when Paul Brody from EY talked about Nightfall. So Celo just integrated with that for, as kind of the first chain for payments use cases for businesses to have sort of private payments in a compliant way. So that's pretty exciting. But, this is 2025, right? We've been thinking about this since 2017, 2018. So it just sometimes things are not it's not the right time yet, right? So I think that's often, there's no regulatory event that's been driving the interest in this exact moment, right? I think it's just, there's some momentum coming around a topic, and then that's sometimes enough to drive adoption. I think the other thing, which is a good example here, is non-dollar stablecoins, right? Which I think, again, something, when we started, I guess Maker had just launched, or maybe it was just the white paper even. So, USDT was definitely around, right? But, very early days. And even then people were like, well, it makes sense to have a dollar stablecoin, right? But at some point, probably there are going to be others. But it's taken all the way till 2024, 2025 for that to really happen. And we're seeing it. I don't know for those of you here earlier today who saw Marcus from Mento and his keynote around non-dollar stablecoins and sort of FX infrastructure, right? It's really only happening now, and it's exciting, right? We have more stablecoins on Celo now than probably any other ecosystem, and a lot of them are non-dollar stablecoins, and they're really important when you want to, for example, do credit, right? Like no one wants to take out a loan in Nigeria in dollars, right? I mean, that's suicide. So it's really, some of these things are kind of things that are logical, and they just, the right moment comes. And sometimes you're right, it's accelerated by sort of a regulatory change or like Genius Act, right? And things really kind of kick into gear, but oftentimes it's just more kind of general, kind of narrative, market readiness, and getting to sort of that tipping point of momentum.
And regarding the stable that pegged not to dollar but some other currencies, how you enforce liquidity on this? Because it's quite hard to build liquidity even for new stable coins. There are a lot of them right now, but if you're building something that it's not pegged to stablecoin, it's even harder.
100%. No, we're still early days, right? So if you think about traditional finance, the euro-dollar market is the most liquid market in the world, probably. I mean, I would think it still is. I haven't checked recently, but so there's a long journey ahead of us to bootstrap even just kind of very liquid spot markets, right, on chain. But I think in the next few years we'll see really yield curves across different non-dollar kind of currencies on chain. You will see people building hedging products, and the nice thing about doing this on chain is the composability is just so much higher than with TradFi, right? So fast forward many years, you would expect that not just sort of spot rates going between currencies, but actually a lot of these more complex derivatives will be a lot more cost effective if you build them on chain, right? But again, we're at the very, very early innings of that sort of industry to really develop. Bootstrapping liquidity, I think that was back to your question. Sorry, I was like, what was the question? It's late, I think it really starts with bootstrapping the use cases around these different, stable coins. So if you're just throwing incentives at whatever, AMMs, and you can probably short-term get a sugar rush and have some liquidity in these markets, right? But it's not going to be sticky, right? So you really have to do the hard work of in-market bootstrapping, lending products, and people maybe having local wallets, right, where they hold local dollar local currency stable coins, and then that demand really driving activity on sort of the on-chain pools, which will then be sort of more attractive for people to LP in. So I think that's kind of a long game, but I think if as an industry, if we kind of play it right, it will kind of be a pretty big reward to bring these markets on chain.
Totally agree. And also we see a lot of new primitives that allows you to build liquidity in a more efficient way. For example, the one that I'm really excited about, it's DEX lending primitive that allows you to build liquidity for new asset in a much more efficient way with less incentives. So I hope to see much more of this stuff in the future. And Kevin, if going back to you, do you have an example where you were needed to compromise between speed and security when you were choosing some specific blockchain infrastructure for deploying a stablecoin?
There's two ways to interpret that, I think. So for managing a protocol that has over 8 billion in stables in circulation, security is always the kind of first and foremost, most important objective. I've come across many instances where security is just the dominant factor. However, that being said, I would say that the unique quality of some of the RWAs that we interact with, we hold about 300 million in BUIDL today, and we have about 770 million in tokenized JAAA, managed by Janus Henderson, $600 billion plus traditional finance manager, right? When you evaluate sort of the security and the risks, a lot of times you'll find that we are relying on some off-chain processes that because the end custody of these assets exist in qualified custodians, that these these fund managers work with, you're able to move a bit faster with what we would regard as a more centralized model. So there are always, compromises that you can make, and in these cases, trusting a $700 billion asset manager helps move things further along faster, while also not compromising on security too much. I think these are the decisions that more protocols are going to be faced with, and I would advocate for taking a holistic view on the risks of an asset.
Okay. And Kenneth, if we continue on this question, if you had to compromise on something, what risk you considering and how you assess them? What's going on top and what's going on bottom?
You're asking a bank what compromises would they take? None. I mean, look, Standard Chartered has been one of the first global banks to really put a stake in the ground and say digital assets is the future of finance, right? That's. I just want to preface that. Really it comes from Bill Winters and Alex Manson, who is my CEO, that really took an early bet since 2016 and said that, we really think that stablecoins and Ethereum and all of this decentralized blockchain technology is on-chain finance, as Rene said, is going to be the future of finance, right? We all know composability, interoperability. We don't worry about all the BIS reports are so negative on stable coins. It's all about tokenized deposits and public blockchains. Oh my God, it's all transparent. How are we going to? But, we believe that privacy is going to be solved. We believe that compliance is going to be solved. We are not blindsided by the limitations currently. We believe that privacy and compliance and AML and all of these things are going to evolve over time, right? So, but coming back to your question, I think that points to the scope of what we can do. We can deal with USDC. Right now, we don't bank Tether, right? And that's about the range, right? But that alone tells you something, right? Out of all the global banks that are actually dealing with USDC, Zodiac Markets is one of the top brokers of USDC worldwide, right? And they do a lot of minting with USDC. Why? Circle banks with Standard Chartered. So a mint and redeem with Circle, with a Standard Chartered bank account, is practically instantaneous, right? So that's where the integration with banking rails is important. Right, so stablecoin. We believe that stablecoins is not just a solution on their own. There's a banking rails, and also there's a last mile payment, right? Because sometimes in Africa there's a fintech app. It could be M-Pesa. So you need all three, right? The banking rails, the stablecoin rails, and the last mile payments, especially in developing countries. Yeah, that's kind of a longer kind of answer to the certain kind of parameters around the risk we can take. And I've been in Standard Chartered Ventures for a year, right? But the rule books that have been built have been ongoing since 2016, 2017, right? Back then when regulators were just trying to figure out all of this, and then a bank says it wants to deal with crypto and blockchain networks, and how do you assess a blockchain network for decentralization? Should what are the risks for all of these things? So that's where I would say, Standard Chartered has done the work, right, in coming up with these rule books. Even though these things take so much time to come up with, it takes a year to come up with a rule book, right, and then by the time it could be outdated in this industry. But at least we've done it, right, and that's why we have a bit of a head start versus the other global banks.
Yeah, and Charles, it's a bit maybe controversial question, but is decentralization is good or bad? In terms of regulation and stuff?
In terms of regulation, I don't know. Generally speaking, again, opinion of my own. When we created this team, almost everybody in the field had title head of digital asset, and we didn't want that. My title is head of DeFi. My colleague could have been chief digital asset or whatever. He used to be the chief index officer of S&P Global indices. Is probably the only chief DeFi officer. So we believe that DeFi was innovation. I've been in the field for a long time, right? So I saw the blockchain but not crypto, blockchain but not Bitcoin at the time, and then the Hyperledger of the world, and the S3 Corda, and the private chain, basically. And all the team that built there, from 2015 to almost 2020, they did a lot of POC, they lingered, and then often they were fired. And the real innovation came back with DeFi, right? We had the SEO, then we had DeFi. And I think it's always going to be like that, right? It's when you have something that is more open, that somebody can just have a great idea and innovate on it, have the composability in some aspects when it can be done without, legal issue, the permissionlessness. I mean, this was great, right? You can have USDT and you can decide to use USDT in your protocol and create, Aave, and you don't need to ask authorization to USDT. And then you can create Morpho on top of it, and you don't need to ask Aave. So I think there'll be a lot of innovation with that. So on my side, again, opinion my own, I think decentralization is great. Now, that said, you don't need everything to be decentralized. Like the same, you don't need everything to be on the blockchain, right? Then you go to the opposite extreme of, I want everything on the blockchain, everything should be decentralized. I think it's great to have Ethereum decentralized, to have the censorship resistance, but there is some protocol that don't really need to be decentralized. Like, so even example of an oracle, right? It makes a lot of sense to have a decentralized oracle when you're looking at the price of Bitcoin and you want to have it on chain. But if it's an S&P rating, I mean, we are the single source of truth. You don't want to decentralize that, right? So there's different use cases. Overall, I think decentralization is very important. But yes, there's also many use cases where the reputation and the trust in some centralized party can be also very relevant.
Okay, yeah, I'm totally agree with you on that. Decentralization is great, but sometimes it's not needed. Sometimes it's better to do things fast. But at least it's nice to have, some emergency button that can be pushed in a decentralized way, so you can stop some really bad exploit if you have something like this. Okay, so.
Yeah, just a quick side. Somebody was mentioning that at some point is, it's between the democracy and the tyranny, right? And the democracy is great for some stuff, but Elon Musk is, and every CEO, they are tyrant in their own world, and they can get stuff done also. So there's different places where one are useful and the other one is not.
And Rene, what are your thoughts about future of stablecoins? Will they converge about in a 2 or 3 general purpose chains, or it will be some specific chain that will acquire most of the use cases?
Wait, I thought I'm going to get a controversial question too.
Very controversial.
If you want, you can answer it too.
I don't know. It's not something I think much about, to be honest. I think there's just so much white space, so much opportunity. So in the short term, it's totally fine to have a lot of different approaches and things. I don't know, just talking about the decentralization, I think there's something that's been really kind of, what's the right word? Stressing me out maybe a little bit. I don't know who here has seen the OpenAI, the latest kind of Sora release earlier, was it yesterday, local time here. I mean, KYC as we know it is going to break, and it's going to break real hard, real fast. I mean, the internet's already shit, right? With all the AI activity, it's going to get really bad. It's going to get really, really bad. And that's a good example, right? KYC, it's centralized providers that store your personal information, and they get hacked. And then, if it happens to be your Coinbase KYC, good night. That's probably, move to an island somewhere and, get a facelift. So I think there's absolutely no way that we're going to survive in this AI world without decentralized solutions. I mean, I think this is going back to some of the core principles. It's maybe less important whether some gaming dApp is decentralized. I don't care. But the core infrastructure that the world is run on, you better hope that some of that has, at least kind of federated systems and things that don't have a centralized bottleneck, right? And so I think That's something that, as I think about decentralization more recently, it's really something that in the context of AI is really, I don't know if it's it's worrying me where we're headed. I didn't answer your question, but
it was a good answer for decentralization. But yeah, let's discuss about the stablecoin infrastructure. Like, will it converge around one or two blockchains, like general purpose one, like Ethereum, Solana, or like we'll have a lot of some specific chain that solves some specific task?
I think in the long term, probably, right? Because there's definitely fragmentation does bring inefficiencies. But then there's also a lot of people focusing on, aggregating and building layers on top of that kind of fragmented landscape. So, yeah, I think in the short term, because it's also like there's the application layer, there's the stable coin themselves, the assets, and then there's the underlying infra, right? And so you're going to just see a lot of movement across all parts of the stack, and probably going to be a while before we are in sort of a more stable equilibrium. What a world play.
Okay, actually, it's a question for all of the panelists, because I think it's like the thing that we are discussing today. So what do you think about, will it converge around one chain or not?
Yeah, maybe I'll say a few words here, because we just starting this engagement with Circle's ARC, right? So privacy is super hard, right? We've all heard about ZK in public blockchains, but ZK has been used for rollups rather more than privacy, just because it's so difficult, right? It's a public chain, and how are you going to make some transactions shielded and some transparent? And clearly, the regulator has to see some of the shielded transactions. So, if it takes a Stripe, if it takes a Circle to implement privacy in an L1, then maybe that's what it takes, right? But I think, as our conversation has been around decentralization and centralization, horses for courses, right? There will be users of Stripe's ecosystem, Circle's key partners, who are keen to have these more TradFi compliant solutions. And then DeFi does its thing, right? On Ethereum, it's permissionless, it's transparent, it's more, you can use MetaMask and interface with whatever is there. And you know what? Both are great, because both coexist together, and they solve actual solutions that TradFi wanting to get into Web3 can actually use, and are not alienated by the craziness of DeFi. And DeFi is free to innovate, right? So actually, to answer back to your question, I absolutely see a world where both coexist.
Great. Ken, what do you think?
Yeah, I mean, I would echo what Kenneth said. A dollar is not a dollar. I think there are many use cases for money, and just for that reason alone, from a consumer lens, you'll have an ecosystem of chains, an ecosystem of networks that is applying utility to stablecoins transacting on a network for different market participants, users, consumers, use cases, etc. I think we're starting to see, various chains take a stance on what kind of target customer segment they want to serve, and be hyper optimized on serving that specific use case. And then with all of the stable coins that are being issued through these various platforms, I think you also see the lanes and the bridges be constructed across each of these ecosystems and networks, so that there's plenty of interoperability to be observed. I would take that kind of similar stance as what Kenneth had.
Earth.
So the blockchain stablecoin, on the stablecoin side, we're exposed to every new stablecoin that do not exist yet, and there's so many new stablecoin. I mean, eventually it would make sense to have a consolidation. We'll see. Now, I also see some new use cases of stablecoin, of companies that are creating it for themselves and not really planning to use it outside. So maybe we'll have a lot there. Now, on the blockchain side, I mean, it would have been an easy world, I guess, if everything was just on one chain. It would be great in some aspect. I think we'll probably have more chain in the short term. Now, let's see what happened with the breaches. I mean, historically, that's where we had the biggest hack. If it keeps happening and it starts to happen with institutional money, maybe we'll start to have some more consolidation. I mean, the problem is when you have all those chain, and yes, there's a lot of protocol that try to solve this kind of intercommunication or like solve the liquidity fractionalization, but some involve trusting either another blockchain, either a centralized party. So I guess nobody knows how it's going to evolve. But I mean, new L1 are launched almost every week also. So I think eventually there'll be a consolidation. And just one thing also, right? Going back to remembering why we are on the blockchain. If you don't care about the decentralization at all, I mean, the blockchain is a database. And there's a trilemma between the speed, the security, and decentralization. So I think there's many new blockchain on the privacy side and some stuff like this that could do exactly the same with an SDK and you know, better speed extra. So I think there'll be more and more blockchain until finally we'll have some consolidation later on.
Yeah, I agree. And we are kind of like short on time, so let's have a last question. What do you think will be like the biggest accelerator of like stablecoin adoption in this next 2 or 3 years?
The regulation.
Yeah, the Genius Act. I mean, the fact that the U.S. government now and Scott Bessent and all of, you know, the U.S. is trying to solve their debt and deficit problem with stablecoins, right? I mean, that's a huge driver. So yeah, let's hope that the Trump administration, you know, really clarifies the rules for stablecoins going forward after the administration as well.
I would say adoption by neobanks and fintechs that are extending the capabilities of these platforms to new users.
I'm going to go with adoption by institutions. You know, as privacy is here now, and people can actually hold their balance sheets, you know, treasuries and stables.
Also agree with all the points. Okay, thanks, guys, for this great panel. And I don't know, maybe if there is some questions in the audience to the panelists. Yeah. Okay, let's go to the bar.
Thank you.
Thank you. Thank you, guys.